The housing market just got crushed and there's more pain to come. I have all the details and what you need to know right here in the video, so let's get right into it. Alright, the housing market is changing and it is changing fast. So in this video, I want to share with you the latest reports that have been released on the housing market and why this market is likely going to experience a lot more pain to come. Let's get right into it. Alright, so a new report that was just released out of Fannie Mae and Freddie Mac is now showing that the 30-year fixed rate mortgage is sitting at 5.51%. That's pretty high, but to put it into perspective, check this out. 1 year ago at this same time, the same 30-year fixed rate mortgage was sitting at 2.87%, sub 3%. That's incredible. That is very, very low. If you happen to lock in during that time on the purchase of a new home, or if you refinance during that time, hey, congratulations. That is an incredibly low rate right there. That's amazing. And you can see right here, 2.87% a year ago up to 5.51% right now is nearly double from what it was a year ago. That's a big move in interest rates, right? So as you can see here, this is rapidly pricing people out of the market because every day, if they're not locked in on rates, if somebody's out there trying to buy a new home right now, every day that goes by and these rates go up and up and up, that just means that they are adding more to their monthly payment every single day as these rates continue to go up. So unless that person lowers their purchase price, they come in with a bigger down payment, they're going to be paying more on their monthly payment. So you can see there's a lot of moving parts. However, check this out. In the same report, it also shows that a 15-year fixed rate mortgage is now sitting at 4.67%, which is also up from 2.22% a year ago. That's incredible. 2.22% on a 15-year fixed rate mortgage is incredibly low. That's like almost free, right? That is so incredibly low. But that was just 1 year ago from this same time last year, right? And here we are, up over 100% just in 1 year time on a 15-year fixed rate mortgage, all the way up to 4.67% today. Again, that's incredible, right? That's a lot. So you can see right now, home of affordability is getting out of reach for a lot of people. If somebody is shopping, unfortunately, it's getting out of reach. Prices are very high because of price appreciation and all the demand driving up prices here over the last couple of years. Coupled with these high in interest rates right now, it's getting really tough for a lot of buyers, right? So I also want to share with you another report that came out as well. This one is out of the Mortgage Brokers Association, and this one is now showing that the average mortgage as of right now is $415,000. However, here's what's interesting about it. Just back in March of this year, the same mortgage, the average mortgage back in March, just a few months ago, was sitting at $460,000. That's a difference of $45,000 in just a handful of months. So what you can see here is that the average purchase price of homes is probably going down. Therefore, people are getting less mortgages, right? Simply because of affordability, right? People are taking less out in the form of a mortgage just because of home affordability, right? Here's another interesting report. And again, I talked about this one in a video the other day, but I want to throw this one out there as well because this is another telltale sign of what is going on here. There's some cracks within this market and we can see them starting to widen quite a bit here. So in the month of June alone, we saw cancellations in the real estate market of pending contracts canceled at a rate of 60,000 contracts that were actually canceled. So in other words, there was a home on the market, there was a buyer and a seller that came together on terms, they had a pending contract, and then all of a sudden, for some reason, probably having to do with the payment, the mortgage, the inspection, something like this, fell through and 60,000 of these contracts were canceled in the month of June alone. This actually represents about 15% of the total contracts in that month alone on these properties. So you can see here, this is the biggest number of cancellations that we've seen since April of 2020. Well, guess what happened in April of 2020? We were all locked up inside of our houses. So I think it's all probably pretty fair to say April was a little bit of an anomaly back in 2020 because realistically, we were kind of forced to stay home. We weren't really able to do anything. For the most part, we were basically said, stay at home, don't come outside. And if you do, that's not a good thing. So that was kind of a weird time that we were living through in April of 2020. But that's the last time that we saw cancellations anywhere near what we saw right now in the month of June. So again, another telltale sign. So here's why I'm saying this market is likely going to have a lot more pain ahead. We know that the Federal Reserve is going to aggressively be raising interest rates here over over their next few meetings. In fact, it's already been talked about that it's likely going to be another 75 basis point interest rate hike in their next meeting, possibly even 100 basis points, probably this next meeting, and even for the next couple meetings here, they're already anticipating at least 75 basis points, maybe even 100 basis points. Well, this is for the federal funds rate. In other words, how much banks are charged to basically lend money to each other overnight. That's what the federal funds rate is. However, all of this also translates into higher mortgages, right? So at the end of the day, even the Fed raising interest rates for the federal funds rate doesn't technically translate directly into mortgages, but at the same time, it all impacts interest rates going forward. So as a result of that, we're sitting at 5.5% right now on the 30-year fixed rate mortgage. There's a lot of consensus out there that we are going to be over 6% by the end of this year. Well, what's that going to do to demand in this market? Are we going to see more people flooding into the market when all of a sudden rates are going up another 0.5% or possibly even more than that? No, people are going to be shying away from this market because that $200,000 house that you wanted to buy, say a year ago, your payment was pretty small a year ago. Well, now today, it's quite a bit more, right? Well, all of a sudden, if you fast forward another 6 months, another year from now, and rates are sitting at 6%, 6.5%, or maybe even more than that, your payment's going to be going up even more and more and more, right? So as a result of this, the Fed is essentially going to take down this market. Just like they're going to take down the stock market, just like they're going to take down the crypto market, they're going to take down real estate as well. And it's all a function of interest rates because the payments continue to get higher and higher. People are getting sick of it, and basically it's just getting out of reach. With high prices on homes and coupled with these high interest rates that continue to move higher and higher, if somebody's not locked in, their payment is getting higher almost on a daily basis. That's very discouraging. If you're in that market and all of a sudden you know, hey, according to my income, according to what I have available, I can buy a $200,000 house. And all of a sudden you wake up 2 weeks later and all of a sudden you think, oh wait, that $200,000 house that I wanted to buy, sure, I can still buy it, but guess what? Now I need to come in with an extra $10,000 down just to make sure that my loan balance is lower so that my payments are still the same. And or I need to negotiate it down $10,000, and or what can I do going forward? Maybe take out a 15-year. Well, then that's just going to jack up your payments as well. There's a lot of different moving parts here, and you can see a lot of buyers out there are really getting pushed to the sidelines as a result of everything going on, mostly interest rates. The price hikes, yeah, that's one thing that's kind of difficult to deal with a little bit, but at the end of the day, these interest rates are tough. These interest rates are really, really tough because there's not a whole lot we can do about it. When it comes down to the pricing, yeah, maybe we can negotiate a little bit. When it comes down to interest rates, you can't really negotiate. Maybe you can shop around and find something that's maybe a couple tenths of a percent lower. Maybe you can wait a few more months and stack up a little bit more money to put as a down payment, which ultimately would lower your payment as well because your loan balance will be lower. But then in that amount of time, maybe interest rates go up another 0.5%. Maybe price appreciation pushes prices higher another $10,000. You know what I mean? So it's a lose-lose battle for so many people in this market right now. You can see here, this market is getting crushed already, and there's a lot more pain ahead for the real estate market. There's a lot more pain ahead for all of these markets. And it's all thanks to the Federal Reserve. Thanks, Fed. Yeah. I mean, seriously. But realistically, it's not them. They're trying to do something to get ahead of this inflation. What it's all coming down to is all of this money that we have in the system, too much money supply floating around chasing too many or too few goods and services. That's what's causing all this inflation. So that's really what it comes down to, is too much money supply. And as a result of that, the Federal Reserve is coming in aggressively raising interest rates, trying to bring down all of this inflation. Does that make sense? So that's what it all comes down to. Anyway, as I do get more information on the housing market, real estate, stocks, or any of these other markets out there, of course, I'll be right here for you, breaking it all down, letting you know how this is going to impact you, your money, your benefits, anything else, the market, interest rates, and of course, anything else going on right now during this very expensive time and very high inflationary time that we're currently living through. So, hope this gives you an update on what's going on with the housing market, real estate, and anything else out there. Of course, I'm always watching everything closely, so make sure to subscribe down below if you haven't done so yet. Share the video with your friends, family, social media, and go back and check out some of the other thousands of videos right here on the channel. Until next time, enjoy your day. Thanks so much for watching, and I'll catch you again later in the next video.